Hey, what's up? This is Greg. It is a beautiful day here, so I'm going to take a walk and do my weekly update. Welcome to DLA Markets, and I'm your host. And I was doing weekly updates pretty consistently, and then I got busy work-wise, and also I just came back from vacation, so there's a little vacation there in doing these, but it's a beautiful day today, taking a walk in the woods, and so I thought I'd use this opportunity to give an update and some of my thoughts as we travel here through space on this planet and experience the financial markets. So, to be honest with you, I was so busy this week in the real estate business, which is my primary business, that I didn't really pay a lot of attention to the market. Not a lot went on in the market. It was kind of a boring week. But there were a couple things that came up that I did want to talk about. I guess the first thing, just a brief word on inflation. Inflation came in a little lower, the CPI. Of course, as I've expressed many times on this channel, I don't really put a lot of stock in the government numbers because I think they're cooked numbers. But it came in at 5%, which is down from what it was previously. My analysis of it was that this was due primarily to a decline in energy. Food was up 8.5%, which is ridiculously high. And I think it's even higher than that. If you look at transportation and services, there's still and rent and housing and things like that, there's still a tremendous amount of inflation in the system. And so even though it is coming down somewhat, it is persistently still in the system. And so I see the Fed on the next meeting in May to probably raise another 25 basis points, okay? So short-term rates continue to go up. This is an issue for everybody that either wants to borrow money for a car, for a house, for anything. That problem is going to continue, and it's going to continue to hit the economy. And I don't see the Fed necessarily backing off. What they might do after the 25 basis points is basically just stand pat for a little while, see what happens. But for the foreseeable future, I think that rates are going to continue to go up. And here's some people coming down the trail. I think I'll go the other way. So basically, the only good part about this is that short-term rates, the 3-month T-bill, the 6-month T-bill, even the 1-month T-bill is still very attractive, over 5%. So if you have idle cash, I'd really be putting it to work, and your liquid resources, I would be putting it to work in those, the shorter end of the curve and those T-bill yields, because they're very attractive. I guess the big thing that I focused on this week was Tesla. Tesla continues to get hit. And I did a full-length video on this, which I'll put both in the description and at the end of this video for you to take a look at. The historic $1 trillion drop in Tesla last year. It recovered from that point, but it's still been volatile up and down. You probably heard the news that they had to continue to cut prices to maintain volume. This is going to put pressure on profitability. And, not only am I bearish on Tesla for the reasons that I outlined in that video, I won't go into all of them here, but I think the EV business and the car business in general is a terrible business. the EV business relies on government subsidies, which one of my rules of business is never invest in a business that relies on government subsidies, because they're unreliable. And think about what's going to happen if a Republican president comes in and the Congress is controlled by Republicans, which eventually is going to happen. They're going to eliminate all this shit, okay? And EV sales are going to go, they're already small, but they're going to go completely into the toilet. So it's nothing to invest in. People were all enamored with Elon Musk, and I like Elon Musk, but although he's a great guy and he's innovative and extremely intelligent, I'm very bearish on Tesla, very bearish on the EV business. EVs are not the answer. I think there's a lot of technologies that are more promising. The problem with EVs, in addition to the fact that all those companies rely on government subsidies, is that we can't get the rare earth metals in this country, and we have to depend on China and other third world countries like Africa. That's a continent, but countries within Africa. And the same environmentalists that are pushing EVs in this country won't allow you to site a mining operation anywhere in this country for environmental reasons. So how are you going to get the rare earth metals? They're extremely expensive to mine. You have to rape the earth to get them. And, ultimately, the same people that are pushing EVs will not let you mine in this country. So the whole thing is ridiculous. It's stupid. I applaud Elon Musk for starting Tesla and all the technological advances he's made within that company. But this EV movement is a joke, and I think it's gonna flame out. I really do. And I would not be a long-term owner of Tesla, not only for the arguments I just made, but for the competition. Okay? Every single car company on the planet is pushing EVs because all the governments around the world are pushing it so intensely. BMW, Ford, Chrysler, GM, all the Japanese companies, they're all doing it. Like, how can Tesla compete with that onslaught? They're better capitalized. They've been in the business longer. They may not have the technological innovation in the short term that Tesla has, but they'll catch up. They'll figure it out. It's not that complicated. And the car business sucks. Car business is terrible. It's heavily capital intensive. You have to deal with unions, and it's extremely competitive. It's not something that you want to deal with. It's not something that you want to invest in. Just one man's opinion. Many people could disagree, but I also think that a lot of the technologies like blue hydrogen, natural gas powered cars and things of that nature, I think eventually will overtake the EV space. This is many years in the future, but because of the many logistical problems and cost problems related to EVs, I just don't think it's a great technology, and I think other technologies will eventually replace gas-powered cars, or at least compete with them. So that's that. Other things that I'm thinking about this week, I'm just finishing up a video that I'm going to release tomorrow, which talks about the ongoing banking crisis, the regional banking crisis. It's not over yet, guys. It's not nearly over, okay? SVB and Signature Bank were just the beginning. The thing I'm focusing on is the regional bank's exposure to commercial real estate, which I know something about because I'm in the business. And I'm coming out with a full-length video tomorrow, which you should definitely check out. And I basically talk about the degree of exposure that these regional banks have to commercial real estate, and how the decline in value of commercial real estate assets resulting from the rise in interest rates is going to be the next shoe to drop in the regional banking crisis. Now, I don't think it's going to be like an 08-09 situation, because the money center banks are not as exposed, they're better capitalized, much lower percentage commercial real estate as a percent of their total assets. So I don't think it's an 08 type situation. But these regional banks have a huge responsibility and a huge position in our economy with respect to lending to individuals, financing commercial real estate, and financing businesses. They're very, very active, very involved in that. And so there's going to be a big economic impact to declining real estate values, defaulting loans, and the write-down and the hits to capital that these banks are going to take from commercial real estate. Okay? So that's the big topic that I'm focusing on this week. Again, full-length video coming out tomorrow, talking about the $2.3 trillion debt bomb that's going to be hitting regional banks. So definitely check that out, okay? Let's go back the other way here. And so, I don't know, how am I feeling about the market? I don't think my view has changed yet. I'm still a bear. I still think that interest rates are going to stay higher for longer than most people think. I think we'll probably have a mild recession. And the reason I say mild recession is because the government has just shoveled out too much money with all these stupid spending bills. The Biden administration with these ridiculous spending bills, trillions and trillions and trillions and trillions of dollars. $5 trillion, which most of which hasn't been spent yet, between the infrastructure bill and the Inflation Reduction Act, which is a joke, of course. It turns out it's a Green Energy Act is what it is, because $1 trillion is going to EV cars and other green energy initiatives. So this money, when this money's flushed into the system, 35% of GDP is government spending. So I've said a bunch of times on the channel, I continue to believe that's going to soften the blow of interest rates and continue to produce inflation, because this money is just creating jobs. It's getting flushed into the system. It's more money in the money supply. It's all borrowed money. And it's absolutely crazy. Now, how this relates to the $32 trillion of government debt outstanding, the government's got a real problem. But nobody talks about it. Nobody cares. Nobody's going to care until the government defaults or something else like that happens. But we all know what's going to happen. The government won't default because ultimately the Fed can print money and monetize the debt. So the government's going to continue to pay its bills rather. But this culture that's embedded in our government of just endless spending has got to stop at some point. And I don't know when that point's going to be, but it's gotten to the point of complete absurdity. And a lot of this inflation that you see, in addition to misplaced Fed policy, is due to this excessive government spending. Okay? So I'm still bearish. I'm still in energy. I still think that's a great place to be. I'm still in short-term treasuries. That's a great place to be right now on a risk-adjusted basis, and I would highly recommend that. And, you know, I have small positions in some of these mega tech companies, but I'm just really not bullish on stocks right now, you know. So I will let you know the exact point when that changes. But right now, I'm not increasing my exposure to stocks. And in fact, I'm going the other way with short treasuries. That's where I think the opportunity is right now. So I guess that's it. That's about all I can think of at this point. I just heard a woodpecker, which is really cool. So check out the video that's coming out tomorrow. It will go into detail on this banking crisis and also the commercial real estate crash, which we're seeing right now in slow motion. And I've got a couple other great videos on the channel that talk about the banking crisis, Tesla, and other things. So check those out in the description, and I'll put some of them at the end of the video. And thanks for watching. This is Greg, and have a great weekend.